Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and I'm joined by my co-host,
Andrew. Bills, I cannot believe it. I know that we're meant to, have a bit of an introduction and talk a little bit, but we are talking about end of financial year, preparing for end of financial year, and I do not know where the time has gone and how we're already talking about this.
It's actually scary when you think about it. It felt like we were doing this last year, leading into the end of year and talking about tax tips and some of the things that you can consider heading into that time of year. It's just crazy.
Yeah. I mean, look, it's crazy how quickly time goes by, and I'm going to throw in a useless bit of information that I probably only know about half right. But I was listening to a podcast and they were talking about how time goes by quicker, or feels like it's going by quicker when you're older. And so they mapped it out over your lifetime, and basically what they were saying was because time goes or feels like it's going by quicker as you're older, and that seems to accelerate the older that you get, that you're actually about halfway through your life at approximately the age of 26, 27. So Billy, you're about 85 to 90% of the way through your life at the age of 65.
Look, that's a depressing start to the podcast, Andrew, and I don't think I can go on.
Yeah, we're done. See you later.
There you go. That wraps
no
up.
one's getting any tax tips.
The tax tip is that life goes so quickly that you don't have to worry about tax planning, right? All right, Andrew, let's get us back on track. And obviously we're talking about tax tips.
Lift up the mood again.
What are we starting with? I mean, a personal favourite of ours, obviously.
Yeah, so all we're talking about, or the thing that we're focusing on first, is your super contributions.
Yep.
Real easy, real quick. You can take advantage of a tax deduction. You can put in some pre-tax contributions to super. So salary sacrificing, your personal contributions.
Yep.
The limit is obviously the $27,500 that you can do in total concessional contributions for this financial year. However, we've done podcasts on it before. Yep. Look back, reach out, whatever it is. You can potentially utilize, provided that your super balance isn't over it, the 5-year catch-up concessional contributions as well, to try and help maximize that. But pre-tax contributions towards super, always a good, quick, easy win.
Yep. So just quick recap on the tax effectiveness of that. You'd be taxed at 15% rather than your marginal tax rate, so it will reduce your assessable income by the amount that you contribute into super. Just to point out, your super guarantee contribution, so the 10.5% that your employer is paying on your behalf, is included in that cap. So just making sure that the $27,500 obviously includes that as well too. So making sure that you don't breach those numbers.
10.5%, which is also going up to 11%.
It is going to.
Watching Billy's TikTok videos, he has just released a video that's going up to 10%. Who said that you can't teach an old dog new tricks? Billy's on TikTok.
Hey, at least I'm trying, right?
Hey, no, all kudos to you.
It's just part of my passion about trying to get financial information. I won't call it advice. But trying to get information out there to people to try and help them make better decisions around their money. So if I can provide a little bit of entertainment as well, hey, I'll try it too, right? So,
absolutely. Shameless plug into your TikTok.
That's it, absolutely. And you know what? I was even mucking around with some of the things that you can put on the screen and the emojis and making them bigger. And if you haven't seen it, definitely get across to TikTok. My handle is at Billy_financial_advisor. That was a bit of a mouthful, I think. Is that what you call it? A handle?
Yeah, I don't know. Done. I'm going to pretend like I know what you're talking about.
All right, moving on to the next one, Andrew. What do we got?
Yeah, so next one is your government co-contributions.
Yes.
So, up to $500 worth of benefit of putting in some money into superannuation.
Yep.
So if you're, and this is for lower income, so threshold is 42,000 up to 57,000. So if you're earning between those, you can get a benefit of putting some after-tax contributions towards superannuation. Government will match 50% of your contribution. So you put in $1,000, they'll give up to $500, benefit or uptick on that. And I don't know any other investment that's going to give you a guaranteed rate of return of 50%. So awesome.
So in this instance, if you earn $42,016 or less, and you put $1,000 into super as an after-tax contribution, the government will put in $500 for that contribution.
Yeah, exactly right.
And that's the maximum amount that you can do. And then you can go all the way up to $57,016, $57,016, and that starts to shade out depending on how close you get to that, and it cuts out at that point in time.
Yep. So if you're earning over the $57,000 mark, that's when the government co-contribution will completely be phased out. But anywhere from 42 to 57, you're getting a scaling benefit of that co-contribution.
Yep. What about, Andrew, if you've got a spouse, you can do spouse contributions as well to superannuation. So there is some opportunity to be able to boost that under the right circumstances. What does that look like?
Yeah, so you've got the ability to put a spouse contribution in. So we're looking at a maximum benefit of $540,000.
$540.
Sorry, $540. I wish it was $540,000. That'd be great. $540 is the maximum benefit that you can utilize in the spouse contribution, and that's if your spouse is earning up to $40,000 per year. If they're earning below the $37,000 mark, you can claim the maximum tax offset of $540. And that's when you put in a contribution of $3,000, which is the maximum amount that you can put towards your spouse's super. Bit of a mouthful, a whole bunch in there. But the long story short is if your spouse is earning up to $40,000 a year, you can claim a tax offset for an amount of money going into their superannuation as well.
Yeah, and I guess talking about that sort of theme that we've been talking about with those last 2 points, it's been about how do we get more money into superannuation. So one of the other options, and once again, not necessarily from a tax perspective, at least at this point in time, but it's also a consideration for around tax time being the end of the financial year. One of the considerations is if you want to get more money into super, you can put money in. We spoke about concessional contributions being taxed at 15% and being capped at the $27,500 per annum. Plus, if you've got any carry forward contributions, you can always take advantage of that as well too. But you've also got what's called a non-concessional contribution cap, where you've got up to $110,000 each year to be able to put in after-tax dollars into your superannuation.
Yep. So I guess the big thing with that is, we look at it, let's use an example and say you want to put in as much as you can towards superannuation because you're over the age of, or you're approaching age 65 and you want to maximize how much you have in a tax-free environment, right? Ordinarily, you can utilize the bring forward rule. So $110,000 is the maximum amount that you can put towards superannuation as an after-tax contribution. If you're utilizing the bring forward rule, or you're bringing forward 3 years worth of superannuation contributions, so your maximum amount is $330,000 if you make that contribution today.
But it locks you out for those.
But it locks you out for the next 2 financial years thereafter. So it's based off financial year. It's not based on when you actually make the contribution. So what Billy's talking about is, let's say you want to maximize how much you can push in. You might decide today, I'm not going to use the bring forward rule.
Yep.
I'm going to put $110,000 in superannuation in this financial year. So you only use $110,000. And then as soon as the financial year ticks over, so 2nd of July, you decide, or 1st of July, I'm going to use the bring forward rule and put $330,000. So in a matter of a few months, you're talking about putting $440,000 towards super, as opposed to looking at it just quite simply and utilizing the bring forward today and that being capped at $330,000.
Yeah, so really approaching, I guess, end of year is looking at those strategies and saying, hey, is there, if that's your circumstance and you want to get money into superannuation, are you in a position to do it from a cash perspective? But if you are, then there's some strategies around it from a timing point of view. And 440,000 in one go is significant. You may have sold, say, an investment property and you want to get extra into your super because down the track it's going to be, it's not going to be taxed at all when you are in pension phase. And just keeping in mind as well too that that's per person. So if you've got a spouse, you can be doing $880,000 in non-concessional contributions in a reasonably short period of time. So really imperative to start thinking about that just before tax time.
With both of those, there's also the ability to look at like a recontribution strategy as well. Yep. So pulling money out of super, putting it back in as an after-tax contribution in order to save some of the death tax, so to speak, that non-dependent beneficiaries might pay. In addition to that, there's also some new rules that came as of the 1st of July in relation to the work test and contributions into superannuation after the age of 65. So one of the other strategies that you could be considering is pulling money out of superannuation before the end of financial year, and then utilizing the catch-up concessional contribution. So this is pre-tax contributions into super, putting that all in one lump sum and potentially, either bringing your assessable income down to zero or paying very little income tax by essentially just pulling money out and putting it back in. Again, I'm grossly oversimplifying this. Yeah. There's a whole heap of considerations that you want to take into account. You want to make sure that you're not breaching contribution rules. You want to make sure that you're not breaching withdrawal rules out of super, especially if it's an SMSF and you're doing it on your own. Yep. We've done a podcast long form just talking about this topic and not condensed into 1 or 2 minutes, but that's another potential consideration. So feel free to have a listen to that topic, reach out to us, but receive financial advice if you're going to do something
definitely on that one. Much more complicated. So definitely need to receive advice on that one. Can be hugely beneficial if you're in the right position to do it. And if that's the case and you think that might be relevant for your circumstances, reach out. We're always more than happy to have a chat and point you in the right direction.
And do it early. Especially because by the time you pull money out of super, you want to make sure that you've got time for the investments to sell down, receive the money, and then have time to then recontribute it back in and claim your notice of intent and whatnot. So do it early and make sure you're not scrambling towards the end of financial year.
Andrew, on the expenses side,
yes,
is there anything that we can do around expenses this time of before the end of the tax year to try and take advantage of the time of year and doing it before the year ticks over?
Yeah, so look, one of the big things is paying for your larger deductible expenses earlier, so this side of the financial year rather than the next side of the financial year. Mm-hmm. Really key thing with that is don't overspend just because you're getting a tax deduction on it.
Yep.
Right, so if you're on a 37% income bracket and you can claim 37% back on whatever expense that you're incurring, you want to make sure you're only claiming 37% back, not the full 100% of the purchase price. So if you're going to incur the expense anyway, one such strategy is incur it now, claim it back on this year's tax return rather than next year's tax return, particularly when you're talking about interest rates being so high. Mm-hmm. An opportunity to claim an expense now this side of the financial year, receive the money back in this tax return, and then have that offsetting your mortgage for a whole other year, as opposed to waiting to claim the tax deduction on it next financial year is another consideration. Mm-hmm. But make sure that it's an expense you're going to incur anyway, not an expense that you're incurring purely just to make yourself feel better, like you're getting a better tax return.
Well, look, on the feel better one, I've actually got one for you that maybe doesn't make much sense from that perspective, but in terms of donations.
Yep.
So if you make a donation over $2, it is tax deductible. So obviously that's a feel-good thing. Once again, everybody's different. There's so many charities out there and there's so many people in need that it's always good. It's a feel-good thing. It's good for karma and the tax...
And good for your tax return too.
Taxman recognises that and gives you a benefit as well too. So donations are always a good part of the strategy as well if you can afford, the cash flow and helping out somebody else or helping a charity in need. And also insurance premiums as well too are tax deductible, specifically on, now I need to be careful with this, specifically on income protection.
Yep.
If you are paying for it out of pocket.
Yep.
So if it's inside your super fund, your superannuation fund will claim a tax deduction on the premiums paid. But if you're paying for it out of pocket, those insurance premiums are also tax deductible as well too.
Yeah, which kind of leads us to the next point as well, is you might consider switching over either your insurance premium or potentially even interest on an investment loan to pay it annually as opposed to paying it monthly. So let's consider you're paying income protection. It might cost you, a couple of grand a year, and you're paying it you're paying a monthly installment in terms of the premiums.
Yep.
You might decide to pay for it in one annual premium today or next month so that you claim the full tax deduction for both this year and, a large part of next year as well, all in this one tax return as opposed to leaving it until next year's tax return. Same story with your margin loans, your other investment loans. You may decide to pay the interest upfront now rather than waiting to pay it progressively over the month.
Mm-hmm. Mm-hmm.
Sorry, over the years.
Yep. And probably on that note, in terms of tax planning or end of year planning around things like capital gains.
Yep.
So as an example, let's use an investment property because that seems to be, a really easy one for people to understand. And it doesn't always work like this, but if you sell an asset and make a capital gain in a particular year where your income is high, might be income from work or whatever it may be, is high, you're going to end up paying a greater effective rate of tax in that perspective. So, and that's the opposite's true as well too. If you've got a capital loss that you want to offset some capital gains in that particular year. But one of the things that you can consider is timing of discharging or selling an asset to try and time it and sell it in a particular year where you don't have any, not that you don't have any tax, you've got less tax to pay, you've got less income in your own name. So I might actually use a worked example because that one's a little bit convoluted. Let's say you've got an investment property and you're planning on selling it. If you sell it and you're near retirement, if you sell it in a year that you're still working, essentially the capital gain, depending on if there's any discounts and stuff, but that capital gain amount will go directly on top of your assessable income, and then the tax payable will be whatever the tax is payable. Whereas if you then defer that sale and maybe do it in a financial year where you've retired and you don't have income in your own name, then that capital gain is not getting added onto your work's assessable income.
Yep. Yeah.
Don't know if I did that one justice.
No, absolutely. It's, you're timing the years that you sell an asset in years where your income is lower. So as a result, from a tax perspective, you're paying less tax, but you also want to plan for it in the sense of you might decide to utilize your superannuation, like your concessional contributions to super in years where your income is higher. So for instance, your concessional contribution cap, you might have 50 grand that's unused that you can utilize either this financial year or next financial year because it's looking back 5 years. And I'm grossly oversimplifying this, but let's say you've got a $50,000 concessional contribution that you can utilize. You might say, in this financial year, my income hasn't been as high because I'm actually planning on selling an investment property next year. So you might decide, hey, I can claim a tax deduction on it now, but I'm not actually going to. I'm going to hold off until next financial year when I sell that asset, when I make that capital gain. That's when I'm going to make, that's when I'm going to utilize the 5-year catch-up contribution so that I can minimize the tax that I'm paying in that year. So really plan for what you're doing is really the crux of what we're trying to say, and structure your expenses, your contributions, everything accordingly.
Yeah, so it could be a combination of multiple strategies.
Yeah, absolutely.
Really big one, I guess, since COVID, even more so.
Yep.
Working from home expenses.
Yeah.
Being able to claim on, if you're incurring expenses that are being incurred in the pursuit of your employment, you can claim those.
Yep. Far more relevant now than what it was previously.
Yep.
So much bigger consideration for a lot of people.
Yep. Things like internet, mobile phone use, portion of electricity, gas.
Yeah. And look, there's a couple of different ways you can do it. You can utilize, the fixed method, the actual method, the shortcut method. The long story short that, I, again, not a tax agent, so I'm not obviously able to give this advice, but document as much as you can. The more you document, the more that you can arm your accountant to better utilize this and better utilize as much of this as you possibly can. Mm-hmm. So if you haven't documented those expenses this year, and it kind of flows into the next point is, okay, you've done like what's happened in this financial year has happened in this financial year, but use that as a means to, okay, next financial year, I need to start planning for it. I need to start, record keeping for really being able to maximize my tax deduction as well. Yeah,
and I think that one's crucial, and that's probably a really good conduit into our next point around budgeting and cash flow planning. And we're big advocates of that, and that really forms the basis of a lot of the financial advice that we deliver and a lot of the financial planning that we do. Andrew, looking at your cash flow plan, looking at your budget, if you're not where you need to be, what do you need to do? Obviously, you need to review it, and that's a prevalent thing to do anyway because costs keep going up. But what does it look like heading into the new year?
Yeah, I mean, look, end of financial year, people are thinking about money. People are thinking about that's already on your mind. So utilize it. It's a good time to, start thinking about, hey, have I reviewed my budget? Is it still, really where it should be? Have my expenses gone up? Do I need to readjust it? Do I need to adjust my cash flow plan? Or is everything still, right from the work that we might have done, either at the start of January or last financial year, depending on when you reviewed it last. But yeah, really good time to review your budget, review your cash flow plan, and really review your wealth plan. It's good time while you're already thinking about money to do all of that stuff as well.
Yeah. And probably the last thing with all of this is getting advice.
Yep.
Obviously, we're big advocates of advice anyway. Speak to your accountant, speak to your tax advisor. Obviously, they're the ones that you need to go to from a taxation perspective. And probably the thing is do it early because you can't do anything after the year's ticked over. You're locked out, so there's not much you can do from that perspective. But if you do it early, you've still got some time to move things around and to make some changes and to do some things. So yeah, that's probably the message out of the back of that one.
Yeah, absolutely. Well, Bills, I can't believe that we're already talking about it. I am going to highlight it again. We're already halfway through the year, and that's absolutely insane. But thanks for another great podcast, and hopefully the message has come through loud and clear on plan for it early. I know we're still a good couple of months away from end of financial year, but thought that we'd get this message out as early as possible.
Yeah. And to our listeners and our viewers, thanks for your attention. Like and subscribe as always, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.